Hello. So we have a great panel here, and I'm going to jump in with hopefully an easy question to start things off, and we're going to have a great discussion. So the first question is, what exactly is an emerging markets country? We see that there's inconsistent definitions from the benchmark providers. Over time, we've seen Argentina go from emerging markets to emerging markets to frontier and back to emerging, and Greece has gone from emerging to developed and back to emerging. And some of the benchmark providers classify South Korea as developed and some classify it as emerging markets. Given that lack of clarity, how do you use the benchmarks to define the opportunity set? And do you see opportunities to go ex-benchmark and explore opportunities in frontier, developed, and emerging? So why don't we start we'll start with Kathy. Thank you.
Thanks. Can you hear me okay?
Yep.
Great. So I'm going to answer it from the perspective of an emerging market fixed income investor. And it really starts the genesis of the delineation between what's a developed market, what's an emerging market, what's a frontier market, really is all about the level of GDP development. And the IMF, the World Bank, and the OECD likewise have different income classifications, and they use the GNI, the gross national income, as a way to delineate the level of development between the different countries. They have high income, middle income, there are gradations within middle income, and then low income. And a lot of the different benchmark providers, the market providers, and in particular for fixed income, the Morgan family of indices, for hard currency sovereigns, corporates, as well as local markets and FX, use that as a starting point to define broadly what an emerging market is. Now, keep in mind that for a hard currency classification of emerging markets, it really goes across the spectrum of your more sort of developed emerging market country, as well as what's considered frontier. So it encompasses the likes of a Venezuela and a Ukraine, up to a China and a Chile, for example. And the differences between whether it's in the local market or the hard or the corporate is really a function of what's outstanding in the market and the extent to which the debt is tradable. And I think that that's sort of the technical definition, but there's also more of a practical or conceptual definition of how to distinguish the different markets, and it really gets down to the quality of institutions and the rule of law, and I think we'll talk a little bit more about that later in some of the questions. But to answer Brad's question specifically, like how, as a manager, do you distinguish between all of them? And I think the best answer is to really have as broadly defined universe of investment opportunities as is possible. And really, if you're a bottom-up, fundamentally based investor, pick the best opportunity depending on the market environment. You don't necessarily want to be so narrowly defined by the benchmark. Even if you're benchmark aware, I think it's a better opportunity for the end investor to really be able to, depending on the market environment, invest in a Ukraine, for example, or an Angola, for example, when it makes the best sense to do so based on your bottom-up analysis as well as the broader market outlook.
Emily?
So my answer is kind of simple to that question, but I'll explain why we take a simple approach. So we're emerging market equity investors. We're mid-cap. We are concentrated and high conviction investors. So for us, an emerging market is one that is defined by MSCI or FTSE. So we pay attention to our universe is the 26 countries now in the MSCI Emerging Market Index. It was 24. And pretty much the same for FTSE minus South Korea. So inclusions into the index and exclusions, or countries that graduate, matter to us because it changes our universe. But given that we're only in 25 companies, and we often, given that it's mid-cap, we often own big chunks of the companies, 5% of the companies, our time horizon's long. It's 3 to 5 years. A lot of times when you think about the macro perspective, and we do have a macro team that's spending a lot of time looking at risks and opportunities, the visibility in countries is often shorter than the 3 to 5 years. It's 12 months, it's 18 months, and it's very sensitive to the electoral cycle. So for us, being at the low end of the economic development curve, so like the Argentina, which is very kind of early stage, that's difficult for us, or if not impossible, because there's no visibility. There's elections coming up. economic policies are not in place, laws can change. So having a 3 to 5 year time horizon is almost impossible in a country like that. On the higher end of the development spectrum, so countries like Korea and Taiwan, we do have investments there. We have 2 in Korea right now and 1 in Taiwan, but we're not there because of the country. We're there because the companies are interesting and they have significant upside potential from our perspective. Generally, we like countries that are growing from a nominal growth perspective, nominal GDP. So Korea and Taiwan just, are pretty fully developed and have less of a growth upside than other markets kind of in the middle of the spectrum. So for us, it's more the middle countries that we're interested in, the countries that have large domestic economies with big populations and a lot of opportunities for mispricing and high quality stocks.
Great, thank you. Bill?
So I think both Kathy and Emily have done a fantastic job in laying out the emerging market framework and how the benchmarks are viewing it, both from a growth or a gross national income standpoint. Are you moving from a low to a middle to a high income country? One thing that philosophically maybe I could just throw out is the migration of a frontier to emerging market to a developed market economy is just part of a natural evolution of things. Normally you start out as a country, you have a natural resource finder, you have cheap labor, that's going to attract FDI, and then you start to have a buildup of income and a consumer class that has savings, and the savings needs to be put to work, and you start to see the build out of financial markets, and along with that comes more responsibility for the government, both in the rule of law, maintaining political stability, building out strong institutions such as financial institutions and the central bank. And as you continue to move up that development spectrum, you become a developed market. And it's kind of fuzzy, I think, with the benchmark definitions of gross national income above a certain average over the past 3 years puts you into that category. So being a fixed income investor, I might just throw this thought out. A developed market economy, in my opinion, is an economy that can produce a safe asset. And what do I mean by that? I mean an asset that will actually maintain its value or gain value in a risk-off environment. So if we think about U.S. Treasuries, bonds, even JGBs, which is an interesting case, which I'll get back to in a second, even Australia and New Zealand, you have fixed income investments, mostly the government bonds, which I'm talking about, that have the property that they'll rally when risk-off happens, even if the currency is selling off. And in emerging markets, you tend to see the exact opposite. When you have a risk-off environment, the currency sells off, and the fixed income sells off, fairly markedly as well. So I agree that having this broad an investment universe as you can provides investors the opportunity to be able to take advantage of different scenarios that come up in the market. On the macro side, when things are a lot more supportive, you have improving global growth. Maybe you can take a little bit more risk and go out on the emerging market spectrum, potentially into frontier countries to get a little bit more yield and return and currency return. But when times get bad, you want to be able to move into those countries that are more developed, that have stronger rule of law, that have more deep financial markets, that have local sponsorship. And the gradation, can be seen even in emerging market countries. Those that are higher up those categories that I just listed tend to sell off less than in the times of risk off than the higher beta countries. And I mentioned Japan. I'll just throw it back out there. The one thing that we talked about migration, not only into developed markets, but then from developed markets back out. And Greece, I think, was a fantastic example. I think Italy maybe, might be the next to go down that route. But I wonder if, the extraordinary policies that are being put in place where, we're doing a lot of expansionary fiscal policy in good times. You have expansion of central bank buying in bond markets, allowing the explosion of debt, both on the corporate and government side, might lead to that definition that I pointed out to you of, what is a safe asset, if maybe at some point in the future we start evaluating that question a little bit more deeply.
Just an important follow-on to Brad's comments. I think oftentimes developed countries are distinguishable because they borrow in their own currency, whereas
Yes.
emerging market countries tend to need to borrow in hard currency, i.e. dollars or euros, And some of them, as their markets develop in their local currency as well.
So I think we're starting to move into the second question, which is that emerging markets offer many opportunities. There's currency selection, country allocation, sector allocation, and security choice. How do you approach the investment problem? What is your investment process? Is it top-down, bottom-up, or do you try and solve for those characteristics simultaneously? So we'll come back to Kathy. And
Great. Thanks. Our process is really both a top-down and a bottom-up, but primarily bottom-up. We start with a top-down analysis, and in that sort of first step, we're really answering the question, what market environment are we operating in? Are we risk on or risk off? So for example, in the current environment, for reasons that we just heard on the prior panel, the uncertainty as it pertains to the trade war, the uncertainty with global growth, we're sort of more kind of a big question mark, middle of the ground. So in that diagnosis of are we risk on or risk off, we might say, you know what, for our fixed income emerging market portfolio, maybe in that environment with the Fed on hold, spreads are going to do okay. A little bit more uncertainty with regard to emerging market currencies and local bonds, although global inflation is low, but we're going to probably want to have a mid-level of risk on, and how we define risk by tracking error. But then it's the rest of the process that really matters, and because getting the country view right is so important, country analysis is critical. And we start with determining our own, we develop our own ratings, we have our own internal ratings, which incorporate both a quantitative view as well as a qualitative view of the country. The quantitative view seeks to capture how far a country is from a crisis, and here it's very objective. We're comparing, and this is where it's interesting, you started out with the delineation between developed market, emerging, and frontier, because we compare countries relative to their own peer group. So again, from a very objective perspective, looking at 5 macro variables, is this country better or worse on a relative perspective? But that's really only half the story. And one of the reasons why we use our own ratings is because we think the rating agencies are backward looking. And we think what really matters for investors is confidence and whether or not there's a negative or positive confidence shock. So we have subjective dimensions of risk as well, where we look at political risk, the political cycle, we look at policy risk, whether or not the monetary policy and fiscal policy and exchange rate policy kind of make sense, are internally consistent, and how well it's articulated. And then, of course, we look at ESG and structural imbalances. And what is relevant is what that feedback loop is into the real economy. That gives us our country view, but then it's where the real security selection process starts, where it's like, okay, based on our overall market view, risk on, risk off, and based on our country view, what's the best thing that we might want to own in Russia? Right now, maybe in Russia, we want to own a mix of spread product, FX, and local bonds, given our view of what's going to happen with the central bank and where oil prices are, et cetera, and the fact that they're less levered to global trade. Maybe in Brazil, we're not so crazy about the BRL right now. Local bonds, a bigger question mark about what's going to happen with the Social Security reform. So maybe there's some quasi-sovereign and some corporate spread stuff that look okay. So the meat of, I think, analysis in fixed income investing is precisely that. It's really, I think, a mix between getting the country view right and then based on that country view, using that to help define relative value, be it in spread product or EMFX or local bonds. And then having the right risk tools so that you understand that those different types of investment carry with them different types of risk.
Great, thank you. Emily?
So even though we're equity, our approach is similar to what you describe. I guess to answer the question about currency, for us, currency outlook is incorporated into the country view. We do have a team of macro analysts that are spending time looking at all the countries that we invest in and looking from a perspective of risk and opportunities, and both equally weighted. If you were to ask us if we're top-down or bottom-up, I guess I would say that our bias would be on the top-down side. That's mostly because when you look at historical performance in emerging markets, you'll see that the most important decision has historically been the country selection decision. That being said, though, as I mentioned before, it's really hard for us to aggressively execute a country view because we're long-term investors and we own big chunks of small and mid-cap companies. So, but of course, when you're looking for opportunities, you want to look at the countries that have tailwinds. So the countries that you see that are on a positive development path. countries that are reforming, countries that might be seeing a falling cost of capital and a trend towards accelerating economic growth. So that's an easier environment to operate in. So when we're looking for companies, it would make sense that those companies would reside mostly in the countries that we're very positive in. So I would say right now our portfolio is about 1/2 to 2/3 top-down oriented, meaning that the opportunity was mostly seen from the top down, but we love the companies that we're in, and we see we have strong conviction in the companies that we're in. And then the other 1/3 to 1/2 is really more company specific, and we're there even though the macro outlook might not be as exciting for us. Countries like Russia are very difficult for, I think, maybe obvious reasons. So the ideas, a company in Turkey or Russia will come up from time to time. But again, we're high quality growth investors, not looking to buy a company at 10 cents on the dollar. So it's really not that consistent with our style. But sometimes you're tempted because the opportunity looks so interesting. We do have a perspective on country risk that we incorporate into our discount rates. And we tried to have that be forward-looking. So a lot of times those opportunities become less interesting when you really give them what is probably a fair country risk premium, given that the conditions that they're in.
On the governance side, actually, I want to have a follow-up question. How much do you see the governance at the country level influencing and directing governance at the corporate level?
Yeah, I mean, so we are ESG investors as well, so there's a lot of hurdles for us. We are a corporate governance fund, so it is, we've been challenged with the thought of investing, like even China for us was difficult. We just started investing in China last year. But yeah, so the country with, where we don't feel comfortable with the rule of law, where there is a history of fraud or asset seizing, that would be very, very hard. We don't want to see our companies go to zero. At the same time, once we feel comfortable enough with a country, we do integrity checks for all of the managements that we're considering investing with and the owners. Most of the companies that we buy are family-owned or controller-owned. And so we do integrity checks to make sure that we want to be partners with the team that's at the helm. And part of what we see as our value add and our upside is convincing these companies to become better companies from a corporate governance perspective. And we're friendly activists, so we want to be able to work with them. We're not going to bulldoze our way in, but we want to be able to work with them. We want to make sure that they're open to the kind of advice that we can give them. So once we get comfortable with the country, then I think it's the management team we need to worry about.
Great. And Bill?
So I'd say our process is, is both, top down and bottoms up. We are focused on fundamental investing, and our process starts out basically with a general screen. So, similar to how the benchmarks are looking at liquidity, market access, tax and regulatory, issues that come up. We want to make sure that the countries and the companies that we get involved in have a liquidity at appropriate level. Are there enough market dealers that will maintain markets in the countries that we're in times of stress? Are the companies that we're looking at, do they have proper sponsorship? So once we get through that kind of initial screen of what we would view as our investable universe, we're combining, I would call it a top-down macro approach with a bottoms-up, fundamental analysis approach. And what do I mean by that? We start out at a firm-wide level. We have meetings at a minimum. We have formal meetings once a month, but really once a week that are chaired by Jeffrey, where all portfolio managers sit around a table from all different asset classes within the fixed income spectrum and equity spectrum. And we discuss our outlook for what is the macroeconomic environment likely to be going forward, not just risk on and risk off, but the view on what is our view on rates? Do we want to be taking duration? What is our view on the dollar? What's our view on certain commodities, especially oil? And then that's going to filter its way throughout the fundamental research. So we move next to country research. Countries we try to evaluate on a fairly standardized basis. We have developed reports internally that look at developed and emerging market countries basically on a very similar, in a standardized format. The reason for that is it allows us quick relative value comparisons against countries that may seem very different at first. So we start out by looking at what is the political structure, what's the fiscal, what's the current fiscal makeup, what is the debt financing needs and the debt situation of the country, are there any outstanding issues that we need to focus on, like a housing bubble, and from there we move to looking at our outlook and the current makeup of growth. What's driving the country's current growth situation? Is it an internally consumer-driven economy? Is this an externally driven open economy that's going to be very susceptible to the current trade wars that are taking place? We move to the inflation outlook because obviously inflation is going to be a first-order driver for domestic yield curves and domestic central bank activity. Then we move to the central bank outlook and say, okay, what is a central bank policy? Are they currently intervening in the currency? Are they doing anything outside of the norm? Are they engaging in any type of quantitative easing or cheap lending scheme to particular market segments? And do we agree with that policy? Do we think that it's building? Do we think that currency interventions depleting reserves and that could potentially lead to a currency accident down the road? And then finally, the broad balance of payments, understanding the inflows and outflows into the country from both foreign actors coming in and buying assets or repatriating the dividends that they receive, and also domestic actors. Are people investing locally or people investing externally? All those variables come together and are put out in a report that allow the analyst for each country to then come to an opinion on the country credit. Do you think that the external spreads are likely to widen, tighten, or remain the same? Do you think what's your view there? On the local yield curve, do you think the curve is going to steepen? Is it going to rally? And then also on the FX, do we think that the FX is vulnerable? Do we think that the FX has some potential appreciation in it? And all this is updated quarterly. So we rely on our analysts to do the work. And then from there, we extend even farther into the countries that we're interested in. And we have a team of corporate analysts that dig in that dig into the country on a company by company basis. And we're looking for, in general, we want companies that both have strong corporate sponsorship or attached to strategic sectors of the economy, companies that are going to benefit in times of stress, potentially from government support. We send analysts to do due diligence on site, and we also have regular updates on each of the companies that are not only within our portfolio but within our investment universe. So it's a very active process. So I would call it both top-down and bottoms-up, driven both by the macro views from the firm and that filter through the investment research and the fundamental bottoms-up research of each individual analyst.
Great. So Bill will touch on the next question, which is given the geographic, political, and cultural differences across emerging markets, how do you stay informed about recent developments? Do you have analyst teams embedded in different countries? Do you travel often? So come back to Kathy for this one.
Sure. We have dedicated emerging market economists who essentially travel to every country that we invest in. And they'll go to China, or Argentina, or Russia, Turkey, at least once or twice a year. But obviously on a continuous basis, we're meeting with government officials, we're meeting with official creditors, we also have a large team of corporate analysts in Singapore and in London. And we get that sort of micro perspective by looking at emerging market companies as well. So meeting with company management and constantly in dialogues with the different people that matter, private sector as well as public sector people. We have investment affiliates that are located in different emerging market countries, and that's helpful. But quite honestly, sometimes I think that if you have a team that's located in an emerging market, you have a little bit too much of a home bias. And you have less perspective. So what we find is much more useful is to be able to compare, because at the end of the day, because we're so relative value driven, we want to be able to compare. And in fixed income, we have a much bigger, to a certain extent, opportunity set in the number of countries and types of countries that we can be investing in. So we really want to compare the views of the Asia economist and what he thinks about Pakistan if we're thinking about investing in the lower rated countries because the market environment is supportive of that, and from a valuation perspective it makes sense to do that. Compare a Pakistan to an Ecuador to an Angola. So you want to be able to bring everybody back together again, and using that same framework that I described earlier, be able to compare them.
Great. Emily?
So we have, again, similar to what you described, we have three parts of our investment team. We have the fundamental analysts, so the equity analysts that are spending all day, every day looking at companies, and they're based in Washington, D.C., but they spend a lot of time traveling to the region. We have locals who are part of the team, but the perspective is clearly not the same as a local perspective. But again, we think that is an advantage and not a disadvantage. Again, the work that we do on the fundamental side is very in depth. We could spend 3 months, 4 months longer looking at companies, making sure that we feel comfortable with all the different elements of the story. We also have a macro team that's constantly traveling to the region, again, looking at risks and opportunities. And then we have an ESG team that's mostly traveling to the region once we're invested. So they focus on the portfolio companies, and again, giving those companies the advice that we have for them on E&S and G. A lot of it's G, a lot of it's on the governance side, but there's a lot of low-hanging fruit that can come from having them understand best practice on E&S as well.
Great. Bill?
Yeah, so the analyst team is broken out really in two teams. You have the sovereign or the country analysts, and then you have the corporate analysts. And both are responsible for consistently updating their views as facts on the ground change or as economic conditions change on the portfolio of countries or companies that they're responsible for. We do that, all our analysts do sit in Los Angeles, but we travel. At least once or twice a year, the sovereign analysts travel to several countries, and the idea there, we do marry it up with official trips where we can meet with officials at the central bank, we can meet with officials in the government, the finance ministry, the economic ministry in certain circumstances, and we want to meet with local investors to get an understanding of really what's happening on the ground. And it helps when you actually talk to policymakers to talk to them face to face and ask questions and kind of see, do they really understand, what's happening, and are they going to do the right thing, or are they pushing forward a political agenda? We also attend conferences such as the IMF World Bank meetings. They happen twice a year, once in the spring and once in the fall. The fantastic thing about these conferences on the macro or country-specific side is it brings most emerging market policymakers into Washington, D.C. On a biannual basis, and it's a great place for us to do all those important meetings in an efficient manner. Similarly, on the corporate side, there are a lot of conferences where they invite, they invite a lot of the company's senior management in, and our analysts go and take advantage of the opportunity to meet face to face with them. We also we try to host every single road show that comes through or participate in the net road shows, and that's when a new deal is coming from. Normally, it's in the dollar-denominated or euro-denominated debt side, but when a company or a country comes with a new deal, they put their either senior management or senior policymakers out on the road and go around and meet with everyone. So we try to take as many of those meetings as we can. To stay up on what's going on. But on top of that, it's, I think, staying in the news flow, staying and monitoring markets on a daily basis. The majority of the job is pretty boring. You come up with your thesis and then you just kind of watch it daily. But when change happens, it happens quickly. So we want people to be accessible, to be monitoring frequently and ready to update. If we need to call a meeting the day of, if something happens, if there has been a change in fundamental view, we want people to, be present and be ready to, present those changes to the portfolio management team.
Can Can I just add something there? What I think is important is for our economists and our analysts to own the alpha as well. So while it's great to be able to diagnose what's happening in a country or a company, what we're paid to do is to figure out how to make money from it. So we make sure in our process that the economists as well are invested in the portfolio construction part of our process, along with the portfolio managers, in understanding, okay, something might be really risky. Like it might, a lot of our economists come from the IMF, and it just pains them to look at Argentina and the quality of the IMF program, the two of them. But at the end of the day, okay, even if you think Argentina is going to restructure its debt, and that's not our base case, where it's trading is likely to be what the recovery value is. So we have an economist who understands that, okay, this is what we're doing. We're in the investment management business, and we're not here to say this is risky, don't invest in it. We're saying, what's the right price at which to invest in it?
Sure. So let's bring it all together with a topic from recent events. What is your view on the trade dispute between the U.S. and China?
Well, it's clearly been escalated. It's incredibly confrontational. I loved the question that the woman asked earlier because she kind of highlighted the perspective from China. And I don't think that there's really much scope for a resolution to happen before G20 and at G20. Maybe there are some signals that, okay, we'll begin negotiations again. But I think that the whole bringing the Huawei part of the discussion into the trade negotiations, it's not just the tariffs. The tariffs were easy to deal with. It's the whole technology and technical aspects of it that I think are much more challenging. So it's clearly a factor, I think, in redefining the global risk landscape and what's going to happen. And I think it lays out, what the investment universe is going to look like up until elections in 2020. And clearly, Trump has certain stakeholders that are important. And maybe he'll want to. It's hard to walk back from. So maybe depending on what happens to the stock market, and what happens to public opinion, and obviously the economy here in the U.S., more efforts will be made to negotiate. But I think from China's perspective, it's a little bit more difficult. And quite honestly, I think that China has a lot more staying power than the U.S. does, given the election calendar here. So I think it's a relevant factor. Whether or not how negatively it impacts U.S. growth, I think is a relevant question. And whether or not that leads to a Fed decision to cut rates is relevant. But that's all actually not all that bad for EM fixed income, at least from a spread perspective.
Emily, do you have some comments?
Sure. I mean, we think that we don't spend that much time on the U.S.-China trade tensions because we think that the impact on the emerging markets, the negative impact is a bit overstated, and it's also not, our portfolio is not that exposed to it. So when we look at China, we see a big country that's slowing, and we know that it's going to continue to slow, for the foreseeable future, whether it's 30 basis points a year or 50 basis points per year. But it's a major economy that's, in many ways already developed. It has major changes that need to take place within the composition of the economy, and we're focused on that. So we see opportunities within China on the consumer side. And see the transition from investment-led growth to consumption-led growth as an opportunity for us from a long-term perspective. But we're not, the fact that the export sector and the currency are showing the impact of the tensions, and there's, we don't have a significant amount of exposure. For us, at 17%, we like our companies. We think that the global environment is somewhat precarious because global growth is slowing, clearly. And there's a deglobalization trend that's happening. And so for us, the best way to counteract that is really, again, by focusing on countries with strong domestic demand that have drivers that are more domestically driven and not really focusing on the global environment. So we like India. For our biggest country exposure is India, at about 30% of the portfolio. Then is Brazil, about 20%, and then China is our third largest exposure with 17%. So we know the direction that it's going. I know I heard someone comment on the big stimulus efforts that's taking place in China, and I agree that clearly we hear about stimulus all the time. But the extent of it is not huge compared to what it's been historically. So we would expect the Chinese economy to have an uptick, a cyclical rebound, and that shouldn't be surprising to anyone. But what we actually like more than that is that they're focusing on the de-risking campaign of the economy, and de-risking is much more important to them than reviving the economy. And so those structural improvements that they're making, and they're taking a longer-term time horizon, is important to us and gives us comfort in thinking that our investments in China are sound.
Would you like to add anything, Bill?
Yeah, Emily, I think you brought up a very interesting point that a lot is being made of these trade negotiations, and we know that things are getting risky as far as the China-U.S. trade talks are concerned. Clearly, the next 300 billion of goods up for 25% sanctions is out for public comment, and if you look at the timeline, I think President Trump will have that in his back pocket when he goes to the G20 meeting with President Xi on June 28th and 29th. It's interesting to point out that President Xi did cut back a 150-page document, and this is according to Reuters reporting, the 150-page document to 105 pages. Now, this is 150 pages of dense material, and he cut a third of it. So it's not like he just cut out the intro and cut out the footnotes. There's clearly some significant issues that are going to be discussed in this upcoming talk between the U.S. and China. And one thing I don't know, and I don't think anybody knows, which way that'll go. So let's look outside then of China, which the China-U.S. trade talks we know are a big risk and 50-50 at best as to whether it escalates or de-escalates. If we look at what's happening with the U.S. as far as their trade relationships, with the European Union, we've delayed now the auto tariffs on the European Union and Japan. President Trump just came back from a Japanese visit, that actually seems to be moving a trade agreement forward. We've removed the steel and aluminum tariffs, so we're trying to make progress on getting USMCA or our new NAFTA 2.0 deal with Mexico and Canada forward. So I think that there are some positive elements on trade. If you put the elephant in the room of the U.S.-China relationship to the side for a minute. And the other point that I'll make is at the beginning of last year, at the beginning of 2018, we were all talking about synchronized global growth. And what happened? Growth decelerated tremendously. And you had the U.S. maintain their growth rate and the rest of the world fall down. But that was a big deviation of expectations from what the market had at the beginning of the year to what actually materialized. Today, everybody's talking about, we're in the late stages of, this economic cycle. We're very concerned about these trade wars. I've seen recession probability models, hit my inbox every 5 minutes. And, I point that out because I think the expectations are exactly the opposite. And it's interesting to see that ever since President Trump did raise the tariffs, I would have expected a much more severe market correction than what we've seen so far. Now, maybe it's going to come if we do escalate the trade war to another 25% on the 300 billion of goods. But so far, you haven't seen the market reactions that we saw in 2018. So I'd be careful using the 2018 playbook to make judgments on what valuations are in emerging markets today. And I think the fact that the market is kind of already skewed towards being negative on their outlook and defensive in their positioning does start to create some opportunities, especially in dollar space.
Great. Well, those are the prepared questions. We have a few minutes left for questions from the audience. Right here.
So, why should I care about EM debt as an asset class? When I'm looking across the opportunities there and developing my capital market assumptions, is EM debt 7+ expected % return long-term going forward with what kind of standard deviation, how much equity beta is buried in EM?
Yeah, go ahead.
So, jumping up. But yes, I do think that just the yield on the hard currency asset class is, has like a close to a 6 or 7% handle. And I think if there's some capital appreciation and credit migration either way, you can get a 7% type of return. If you look at it from a long run Sharpe ratio perspective, it far surpasses, it's about the same as US high yield, far surpasses EM equities because of the FX component. Obviously for EM equities, and FX has been underperforming. But a really good way to think about it, first of all, emerging market debt it's a higher yielding asset class, right? The average rating is high double B. And there's a wide variety, and this is sort of pertinent to what we've been talking about all day. There's a big variety of types of countries that comprise the EMD universe, some of which are defaulted, some of which are CCC, some that trade at like 18% type yields, and some that trade at 3% yields. And if you have the right framework over time, and the volatility is about 8% for the index, if you have the right framework, you can generate high single-digit returns, consistently and the index Sharpe ratio, depending on the time frame, is like a little over 0.5%. But if you focus on shorter maturity debt as a subset of the asset class, so you don't have a lot of duration, the Sharpe ratio can be, again, depending on the time frame, can be over 1. You can have a 1 Sharpe ratio if you're not taking on a lot of duration risk. And over time, if you look at the points where the market has sold off more than 5%, be it because of last year, and in 2018, what's different between 2018 and this year was the Fed, right? The Fed's not in play in the same way it was last year. If you look at those periods of time, on average, it takes 4 months for just the index to get back to where it was, from trough to where it was before it sold off. And the returns in the subsequent 6-month and 12 months are double digit. So from my perspective, if you're a strategic long-term investor, which is I think what you have to be in emerging markets, like they're just too attractive to ignore.
Bill, do you have any?
No, I was actually,
that's very
we've
comprehensive.
done the same research that you have, Kathy, that I think the point that she made, and I'm just going to put a fine tip on it, when you look at the dollar-denominated emerging market debt as an asset class versus emerging market equities since, I think we looked at it since 2005 and 2006. I forget exactly when the JP Morgan index became available, but she's exactly right. It generates just about the same return with less drawdown, and the Sharpe ratio, is almost double. So obviously, you're not only are you picking up, your yield of, let's call it 6.5%, but it also has another interesting property that dollar-denominated emerging market debt trades as a spread over the U.S. Treasury curve. So even as spreads blow out in a time of risk aversion, you get a little bit of Treasury rally. And when you're comparing that against an EMFX component that's embedded in equities, on a risk-adjusted return basis, it makes a lot of sense. If you're doing that asset allocation out of U.S. equities into emerging market equities, I would take that bucket of emerging market equities and split it as a true long-term allocation between dollar-denominated and maybe your emerging market equities, and then use the EM local debt as kind of your alpha generator, on top of that. Because you can then pick up really juicy yields, but you're also exposing yourself to FX risk, and you are exposing yourself to a lot of economic and political risk as well.
Great. Do we have more questions? Here?
Yeah, given the importance of country selection that you guys discussed, do you have a favorite country right now or country story, and maybe on the other side, an unfavorable story?
We'll start with Emily.
Yeah, so as I mentioned, India is our top country in our portfolio. They've just gone through a very important election, and it's a very strong mandate for Prime Minister Modi. He has a lot of work to do. So India's, in a way, very interesting when you compare it to China. It's about a fifth of the size of the economy, and the potential that it has, so it's probably the fastest growing major economy in the world if you look at it from a nominal growth perspective. So, and it has the potential to continue to grow at that pace or accelerate in the years to come. And there aren't many stories like that. So you've got a really interesting growth, potential growth story. And again, the growth is already there, but it needs to accelerate from where it is currently. And you've got a lot of reform that needs to take place. And he's a reformist leader. And he has done significant reform over the last 5-year term. So I think there's a lot of like low-hanging fruit in India, and we're invested in SMID-cap, so SMID-cap has underperformed the large cap. You'll hear that the Indian market's at record highs and all that, but that's all large cap. It's not really the SMID-cap. So SMID-cap has lagged, and the extent to which it's lagged is kind of back to historical highs. So the spread differential is very significant. And Brazil we like because similar to India, you have a new person in power who's hopefully going to has a strong mandate and who will should be instrumental in pursuing reform and getting reform passed, which is what Brazil needs. And Brazil is an economy, a major economy that has not grown for years. 2 years of negative 3% growth in a row, and then since then it's grown 1%, 1%, and they just announced a negative growth for the first quarter of this year. So there's not a lot of cost pressure that can get in the way of the economy growing. There's a lot of room for the falling cost of capital to translate into better earnings growth. And there is a significant story of, like the majority of the population is in favor of this reform. And so we can expect that it has to happen because it's so important. And they know that. So those are the two economies or the two markets that we like the most from the top down, and the companies are excellent in both cases. So we find a lot of interesting opportunities, great earnings growth, and a lot of idiosyncratic stories, so stories that will do well regardless of what the GDP is.
Great. Well, that's our time. Thanks to the panels.
Thank you, Brad, and the panel.